everybody knows that everybody knows stocks can't fall long. And we know mechanically the plumbing is in place or being put in place to keep this going and ameliorate any sell-offs. So to me, I think what stops it is more inflation and politics, political instability. And we're starting to see that, but it's not quite there enough. But I think the everybody knows portion of this is a dangerous point in time, because it just means more and more the bond market's going to sell itself faster and faster to the Fed. And that's really good for gold. I still think gold has, a lot of upside on a number of different metrics, whether it's, the number, that you need to, the balance, China's trade balance, right? So 2024, China ran a $990 billion trade surplus. Everybody says, oh, it's unfair. It's unfair. Well, China imported 1,300 tons of gold. $22,000 an ounce, China runs a flat trade balance, right? So that's $22,000 is where we got to beat a flat balance. That has very important implications for the dollar were that to happen.
The financial system is entering a phase where the illusion of stability is beginning to fracture, even as markets continue to set new highs. The growing recognition that the stock market has effectively become the economy and is now required to support U.S. government financing creates a dangerous feedback loop. As deficits balloon and the Fed quietly absorbs more Treasury supply, the bond market becomes increasingly fragile. Rising inflation pressures, geopolitical instability, and accelerating global demand for alternative reserve assets are forming the backdrop for a significant monetary shift. In this environment, gold remains structurally undervalued despite its decisive move, and its role within global reserves continues to expand. Luke Gromen, a longtime macro analyst known for connecting monetary mechanics with geopolitical strategy, emphasizes the growing stress in the Treasury market and the inevitability of further central bank intervention. His work highlights how persistent deficits, increased bill issuance, and reliance on Fed liquidity function as stealth stimulus, fueling inflation while pushing investors toward hard assets. As confidence in long-term treasuries deteriorates, gold stands positioned to overtake the dollar as the dominant reserve asset, reshaping the global monetary landscape. Now, we present the clips from Luke Gromen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I continue to think gold is the cheapest asset on the board. I say that because it is still, with this huge move, at 11 or 12% of the market. The market value of U.S. official gold is still 11 or 12% of U.S. foreign held debt outstanding in total. And long-term average is 40%. 1989, when the Berlin Wall came down, it was still 20%. Dollar crisis in 1980, it was 135%. So I think it is still by far the cheapest asset on the board. In terms of why I think it's still, I think, and I said this at the time, we saw that pullback. We saw the VAT and China issue. It's two simple questions for me in terms of gold. Is gold still a buy? A, do I think the United States has made a decision to allow China to build its entire military for it and critical rare earths, all of it, just offshore the rest of it, in order to defend the bond market? And the answer is there's no chance of that happening. Question number two, do I think China and Russia are going to make a Yeltsin-like choice and make themselves economic vassals of the U.S., sell all their gold, replace it with treasuries, and hold 10-year treasuries yielding 3 or 4% when U.S. debt issuance grows 8% CAGR as it has since '08? And same thing, I think there's 0% chance of that happening. And so as long as we are continuing to try to reshore, the world needs a new reserve asset, because you would have to be an idiot to own, to be reserving as a sovereign, particularly one who's in conflict with the U.S., the long-term treasuries, the long-term bonds of the U.S. Treasury, when the U.S. is A, in conflict with you, and B, literally borrowing money to buy commodities. You should just buy commodities or something that better represents a commodity proxy, which is gold. Gold has risen significantly in commodities over the last 3 years, over the last 5. It's tripled in the last 3 years, the gold S&P commodity ratio, Goldman Sachs commodity ratio. It's up more than that over the last 15 years. And so as long as we're continuing in this direction, gold, which just went over treasuries in global FX reserves, I think it's going to continue. And I think within 1 to 2 years, we're going to get a headline that says gold is now bigger than US dollars all in global FX reserves. And that'll be a combination of price, and it'll be a combination of continued tonnage from central banks. And that's going to be, I think, a really interesting moment in time that's going to trigger a lot of cognitive dissonance among sort of, the US dollar uber alles crowd, which is, what's, what are we still on a dollar backed system if gold's the biggest reserve asset? And I think, it'll be a dollar centric system, but it'll be gold based, not gold backed, but gold based. But so I still think gold has, a lot of upside on a number of different metrics, whether it's, the number, that you need to, the balance, China's trade balance, right? So 2024, China ran a $990 billion trade surplus. Everybody says, oh, it's unfair. It's unfair. Well, China imported 1,300 tons of gold. $22,000 an ounce, China runs a flat trade balance, right? So that's $22,000 is where we got to beat a flat balance. That has very important implications for the dollar were that to happen. You look at it relative to commodity markets, it's still, the oil market alone is still 6, 8, 10 times bigger than the gold market in annual physical production terms. So I think, gold is replacing treasuries in global FX reserves. I think people are starting to admit that now after years and years of it being very obvious. But I think it still has a long way to go. I think it can go a lot longer than people think. I don't think the markets are necessarily the constraint anymore. In other words, we just talked through standing repo every time it gets used, the stigma around it will get less and less, right? So that'll get, the next time we have some sort of quarter end issue or whatever, it won't be 50 billion it'll get hit for, it'll be 75 or 100 billion for a few days, and that'll bring repo back down. And then the next time it gets easier and easier, right? It's the old, Mr. Brownstone with Guns N' Roses, right? Used to do a little wouldn't do it. So between that reality, between the Fed gonna be regrowing their balance sheet, calling whatever they call it, right? The purists will say, well, it's mostly at the short end, so it's not QE, it's just, supplying liquidity and reserves. I don't care. But has struck me in the last few weeks, has been a growing recognition by a growing number of market participants that are realizing that the stock market is de facto the economy, that the stock market de facto backs the treasury market, which things you and I have talked about for some time. When we first brought it up, 7 years ago, 10 years ago, when I went through the IRS data and showed that personal consumption expenditures of the United States, are 2/3 of GDP. And we went to do the IRS data and we said, if you just look at net capital gains plus taxable IRA distributions, those two numbers alone, which don't include stock-based comp, those are 200% of the annual growth in PCE, right? So consumer spending can't grow mathematically unless stocks rise. And we highlighted that at the time. It was very controversial. My point is, it's not controversial anymore. Everybody knows that A, the stock market is effectively the economy, B, they need it to fund the treasury market, and C, therefore, any dips are to be bought because you take stocks down 20, 25%, which earlier in our careers was like, okay, kind of a nasty correction, but so what? Now if stocks drop 20, 25% and stay there for long enough, receipts are going to drop 15 to 20% within 3 to 4 months, and we won't be able to afford to pay the entitlements plus the interest. Forget about defense, forget about national parks, education, labor, all the other. We won't be able to pay entitlements and interest if your stocks fall 20, 25% and stay there for a few months. So my point here is that everybody knows stocks can't fall long. And I think it's rapidly being understood. And we know mechanically the plumbing is in place or being put in place to keep this going and ameliorate any sell-offs. So to me, I think what stops it is more inflation and politics, political instability. And we're starting to see that, but it's not quite there enough. But I think the everybody knows portion of this is a dangerous point in time, because it just means more and more the bond market's going to sell itself faster and faster to the Fed. And that's really good for gold. It's really good for Bitcoin. It's I think it's great for the stock market in dollars. I think stocks will keep falling in gold terms and Bitcoin terms over time, but we'll see. But I think they have taken the brakes off this thing. Like, it is only throttle. I disagree with a lot of the purists on this, as they say, well, QE is technically bringing down rates, at the mid to long end to drive. What they almost all uniformly failed to mention is where it does bleed into the economy. We're running still nearly $2 trillion deficits, and we're financing a big chunk of it in bills. And so if you're buying bills to prevent rates at the short end from rising, be that on a spot basis through standing repo, or be that on some sort of program to make sure bank reserves are high enough, because, oh, by the way, bank reserves get drained down when banks buy this stuff. You are financing deficits, and those deficits are being spent into the economy. And, oh, by the way, when you are buying, when a government runs a deficit and then finances it in short-term markets, that is very cash-like, right? So a dollar bill is just a 0% yielding bond of zero duration. That's why it says Federal Reserve note on it. And so if you're issuing bills and the Fed's buying those bills with money they're creating, you are essentially funding the government with a close relative of cash, particularly the closer the rate on those bills gets to zero. What's the difference between a bill yielding, 25 basis points for 3 months and cash yielding 0% now? Like the difference is, and my point is that like that's Weimar like, that's Banana Republic like. If you're going to run 7%, 6% of GDP deficits and you're going to finance it heavily in bill markets that the central bank's going to buy, that's as stimulative as it comes. So I always, I've stopped getting into discussions about it on X because it's just maddening. Because a purist like, well, it's not QE, it's not stimulant. I think that's total crap. The release valve is through the deficit spending.
The recent tightening in funding markets has revealed just how stretched the U.S. Treasury system has become. A surge in the Treasury general account, massive front-end issuance, and relentless refinancing needs have created a treadmill effect, one where the government must continually issue more short-term debt to stay afloat. This pressure has spilled into repo markets, where rising rates signal growing systemic stress. Hedge funds, now the largest marginal buyers of U.S. Treasuries through highly leveraged basis trades, are vulnerable to even modest shifts in funding costs. As repo rates rise, these leveraged positions risk forced unwinds, which could lead to disorderly moves in both bonds and equities. To prevent such a cascade, the standing repo facility is quietly acting as a form of on-demand yield curve control, injecting liquidity whenever the system begins to crack. This stabilizes markets in the short term, but underscores a deeper reality. Deficits are too large, long-term demand is too weak, and the structure now depends on Federal Reserve intervention. These dynamics point to a monetary environment increasingly favorable to hard assets as confidence in the debt complex erodes. Let's get back to the interview.
What the Fed came out 3 weeks ago in a white paper and noted has been by far the biggest marginal buyer of U.S. Treasuries in the last 3 years, which is hedge funds. So let's start with just the funding issue. It rose. It was signaling funding tightness. What I think was really interesting about it is that what was a significant contributor to that funding tightness was the U.S. Treasury TGA, Treasury General Account, which is essentially just the Treasury's checking account, and it rose to the highest levels in 3 or 4 years. It was up near $1 trillion. And when I first saw that, I thought, all right, well, probably some of it's related to the shutdown. They're just not spending money. But then I wondered if there wasn't some level of 4D chess being played by Besant, which is to say this episode of SOFR, repo rates rising, was reminiscent of a similar measure of rising stresses that we saw in 3Q19. Where we saw back then it was Fed funds rate rising over interest on excess reserves. This is SOFR over interest on reserve balances. But back then what was happening was Fed QT was was basically, in addition to U.S. deficits, crowding out the U.S.'s own banking system. And that's Fed funds went over interest on excess reserves. That's what that message was. And ultimately, there was a moment in time where repo rates spiked to 8 to 10% for, I think, 48 hours in September of 2019. And the Fed came in, began regrowing their balance sheet by buying bills, which is not, they called it not QE. Technically, it wasn't QE. Markets didn't care. It was liquidity. And so this was looking like that kind of a setup. The difference was that it was the TGA crowding out the funding markets on the margin, not U.S. deficits, or so we thought. So that was my base case was, okay, well, we see the TGA, maybe Besant is doing what Jamie Dimon and JP Morgan have been said to have done in the 2019 case. In 2019, apparently, JP Morgan was the biggest lender into repo, and they curtailed repo lending, and that, boom, triggered the repo rate spike. I don't know why they did it, but that's the postmortem says that's what happened. So for me, when I first saw the TGA being the reason for this, the marginal reason for this repo tightness, I thought, well, maybe he's playing 4D chess, he being Besant, and trying to squeeze funding markets to force the Fed's hand to come back in and do more not QE, supply more liquidity. And I had a conversation that was going into Halloween weekend. Over that weekend, I had a really interesting conversation on X with John Comiskey, who's a Treasury funding analyst, who pointed out, like, no, it's not. There's nothing nefarious here going on. There's no 4D chess being played by Besant. Here's my Substack. I was forecasting the TGA to do this, and based on what the borrowing needs were going to be. And so I asked him, I said, is it current year deficits that's driving this? He said, sort of, but not really. What's really driving the rise in the TGA is the mandated need for him to maintain sufficient levels of liquidity in the TGA for expected outlays, and the reality that for the last 30 months, Yellen and then Besant have shifted issuance to the front end. And so initially, they shifted issuance to the front end, great, but then they kept doing it at crisis levels for 30 straight months. And after 30 months of this, they now have what is essentially a treadmill problem, or a Red Queen problem, as they call it in the shale patch, where you have to go faster and faster just to stay in the same place. These bills are now coming due to be refinanced more and faster and more and faster. I was looking back historically, just by way of comparison. If you look back to third quarter of 2018, year to date through that point, fiscal 3 quarters, the gross issuance of bills was $5.5 trillion in 3Q18. By way of comparison, through the same 3 fiscal quarters this time, in the latest TBAC report, they're at $22 trillion in gross issuance. So the gross issuance has risen 4x, and that's just coming faster and faster. And so once I realized that, the penny dropped for me, because you can see this setup of, okay, repo is straining because TGA is rising. TGA is rising because he needs to have more liquidity. He needs to have more liquidity because there's more and bigger frequent refinancings of bills. There's more and bigger refinancings of bills because we've been unable to term out debt. We've been unable to term out debt because there's been insufficient price insensitive demand at the long end. And then you go back to the first point about the hedge fund side. The biggest marginal buyer of the long end has been highly levered hedge funds centered in the Caymans. The Fed white paper says they own up to $1.8 trillion in treasuries. That makes them over twice the size of China, almost twice the size of Japan, and 3 times the size of the UK, the official 3 biggest creditors of foreign creditors of the US. And so these hedge funds, who are by far the biggest foreign creditor of the US over the last 3 to 4 years, are mostly, per the Fed and per our own readings, basis trades, which are highly levered, anywhere from 50 to 100x, which is mostly funded in repo, whose rates are rising because there's been so many bills. So go back, wash, rinse, repeat. You could quickly see why this problem could become systemic, because if repo rates keep rising, you're going to squeeze the funding of these hedge funds. They will be forced to degross on their basis trade. They own $1.8 trillion. It's an illiquid market anyway, because we've just discussed we can't term out our deficits. Yields would start to go up in a disorderly fashion. Stocks would start to go down in a disorderly fashion, which would lead to more degrossing by these levered hedge funds in treasuries and in stocks. Wash, rinse, repeat until somebody comes in and buys a bunch of bonds, most likely the Fed. Now, that is how it would go if we didn't have the standing repo facility in place. The Fed, to their credit, seems to have anticipated this. We saw standing repo get hit on Halloween for $50 billion. And the repo rates began backing down through the ensuing week. And so for my eyes, the definition of yield curve control is rates go up, central bank grows its balance sheet, brings rates back down to where they want them to be. The Bank of Japan has been doing it for years, if not decades. When I describe what we just saw, we just went through very verbosely what drove it, but repo rates went up. Standing repo balance went up $50 billion in a day or 2 days, and then repo rates came back down. That's yield curve control on demand. That's like, for me to understand something, I need to see, it's not what it's called, it's what it does. And what that did was supply more liquidity to calm the repo market. And by calming the repo market, you took away the risk of this debt spiral that would have been forced degrossing of $1.8 trillion of treasuries, owned by hedge funds, financed by repo in the Caymans, which would have taken everything down. So I think it's a very powerful moment in terms of realizing they've got the facilities set up to basically yield curve control things on demand as they need it, which, is what it is.
The strain building inside the U.S. funding system is no longer a minor technical issue. It's a symptom of a financial architecture pushed to its limits. Decades of expanding deficits, front-loaded Treasury issuance, and reliance on leverage-driven foreign buyers have created a cycle where liquidity must continually be manufactured to prevent instability. The recent surge in the TGA, rising repo rates, and the vulnerability of basis trade hedge funds expose how sensitive the system has become. Any sustained rise in funding costs risks triggering forced deleveraging, rapid bond sell-offs, and cascading stress across equity markets. The only mechanism capable of preventing that outcome is aggressive Federal Reserve intervention, effectively turning yield curve control into an as-needed function. This reality signals a profound shift. Debt markets are no longer self-sustaining, and the dollar framework now relies on permanent liquidity support. In such an environment, hard assets are likely to benefit as confidence gradually shifts from the financial system toward tangible stores of value. The next phase of this transition will reward those who prepare early and understand the direction of monetary currents. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.